Most people think that when bank stocks are rising and the biggest financial institutions are reporting solid profits, everything must be fine. But the reality is often more complicated. Some of the strongest looking markets can also be the ones carrying the biggest unanswered questions. Right now, America's largest banks are showing impressive numbers on the surface. They've passed regulatory stress tests. Many have reported better than expected earnings, and their balance sheets appear healthier than they were before the 2008 financial crisis. Yet, behind the scenes, something unusual is happening. Trading activity in bank stocks has increased. Investors are paying closer attention to economic data than they have in months, and analysts across Wall Street are asking a simple question: what are we missing? If you're a homeowner, an investor, someone saving for retirement, or simply trying to build financial security over the next decade, this isn't just another story about banks. It's about understanding the signals that often appear before major shifts in the economy, and once you see the numbers clearly, you'll understand why this matters more than most people realize. One of the biggest misconceptions in finance is believing that a strong company automatically means a risk-free investment. That's not how markets work. Markets don't only react to where things stand today, they react to where investors believe things are heading. Tomorrow, think about driving a car on a clear highway. You don't wait until you hit traffic to ease off the accelerator. You slow down when you see the brake lights several hundred meters ahead. Financial markets operate in much the same way. Investors constantly look for early warning signs even when today's headlines appear positive, and that's exactly where we find ourselves today. Over the past year, America's largest banks, including J.P. Morgan Chase, Bank of America, Citigroup, and Wells Fargo, have continued to demonstrate resilience. They remain well capitalized, hold significantly more liquidity than they did before the global financial crisis, and continue to generate billions of dollars in quarterly profits. If you only looked at those numbers, you might conclude there's nothing to worry about. But markets rarely focus on today's earnings alone. Instead, they're asking questions about tomorrow's economy. Will borrowing slow? Will consumers continue spending? Can businesses keep investing if economic growth cools? And perhaps most importantly, are today's stock prices already assuming everything will continue going well? These questions matter because banks occupy a unique position in the financial system. They don't just reflect the economy, they help drive it. Every mortgage, business loan, credit card, auto loan, and commercial investment passes through the banking system in one way or another. When banks become more cautious, the effects ripple outward into nearly every household and business across the country. That doesn't mean a crisis is coming, but it does mean that watching the banking sector often provides valuable clues about where the broader economy could be heading. One reason Wall Street has become increasingly attentive is that the economic picture has become more mixed than many expected. Inflation, while significantly lower than its peak, hasn't completely disappeared. Interest rates remain considerably higher than they were just a few years ago. Consumers are still spending, but many are relying more heavily on credit than before. Businesses continue hiring, yet the pace of job growth has cooled compared with the rapid expansion seen after the pandemic recovery. None of these trends on their own signal immediate danger, but together they paint a picture of an economy transitioning into a more uncertain phase. And uncertainty is something financial markets tend to price in long before the average person notices it. This is where understanding the numbers becomes more important than simply reading headlines. For example, when economists discuss economic growth, they often focus on averages, but averages don't always tell the full story. Imagine 10 households living on the same street. If one household earns $10 million, while the other 9 earn $50,000 each, the average income looks remarkably high. Yet that average doesn't reflect the financial reality of most families. That's why economists often pay closer attention to median figures, the point where half the population earns more and half earns less. Median income, median savings, and household wealth provide a much clearer picture of how ordinary Americans are actually doing and recently, those median measures have revealed increasing financial pressure. Many households continue facing higher grocery bills than they did just a few years ago. Insurance premiums have climbed. Housing affordability remains stretched in many parts of the country. Even families whose incomes have increased often find that larger portions of their paychecks disappear into fixed monthly expenses. This creates something economists call margin pressure, not corporate profit margins, but household margins, the difference between what comes in and what goes out each month. When those margins become thinner, families become less flexible. Unexpected medical bills, car repairs, or temporary job losses become harder to absorb. Credit card balances rise more easily, savings rates often decline, and eventually consumer spending, the engine of the American economy, begins slowing. That's one reason Wall Street watches consumer financial health so closely. Banks don't simply earn money from deposits. They earn money by lending. The healthier consumers are, the healthier bank loan portfolios tend to be. But when household finances become increasingly stretched, lenders naturally begin watching for early signs of stress. That doesn't necessarily mean defaults will surge tomorrow. It simply means risk calculations begin changing. And that's exactly what sophisticated investors are trying to understand today. Not whether banks are weak, but whether the environment around them is quietly becoming more challenging, because history has shown something interesting. Major financial turning points rarely begin with dramatic headlines. They usually begin with subtle changes in behavior, consumers borrowing slightly more, businesses investing slightly less, banks becoming just a little more selective, investors asking a few more difficult questions than they were 6 months earlier. Individually, none of these developments seem particularly alarming. Collectively, they can signal that the financial landscape is evolving, and that's precisely why Wall Street is paying so much attention. Not because today's banking system appears broken, but because tomorrow's economy may look very different from yesterday's. In the next few minutes, we'll examine the specific numbers that investors are watching, why several economic indicators are quietly flashing caution, and the one area of the financial system that many ordinary households have never heard of, even though it could play an increasingly important role in determining where markets go next. The biggest question investors are asking today isn't whether the banking system is healthy, it's whether the economic conditions that helped banks produce such strong results over the past few years are beginning to change. To understand why that matters, we need to look beyond quarterly earnings and focus on the indicators that professional investors monitor every single day. These aren't flashy headlines. They're the quiet measurements that often reveal changes long before they become obvious to everyone else. One of those indicators is consumer debt. For much of the past decade, low interest rates encouraged Americans to borrow. Mortgages became cheaper. Auto loans were affordable. Businesses could finance expansion at historically low costs. Borrowing wasn't just common, it made financial sense for many households, but today's environment is very different. Interest rates are significantly higher than they were just a few years ago. That means new loans cost more, refinancing is less attractive, and carrying existing variable rate debt has become increasingly expensive. Imagine two families buying identical homes. One locked in a mortgage at 3% several years ago, the other is buying today at nearly double that rate, even if the homes cost the same. The monthly payment can be hundreds, sometimes over $1,000 higher. That's hard money that can no longer be spent elsewhere in the economy. Multiply that reality across millions of households, and you begin to understand why economists pay so much attention to borrowing costs. The same principle applies to businesses. When financing becomes more expensive, companies often delay hiring, postpone expansion projects, or reduce capital spending. Those aren't dramatic decisions that make national headlines overnight. They're gradual adjustments. But when thousands of businesses make similar decisions at roughly the same time, economic growth naturally begins to slow, and this is where many people get caught. Most Americans assume that if unemployment remains relatively low, everything must still be healthy, but employment is what's known as a lagging indicator. In simple terms, companies rarely start laying off workers at the first sign of slower growth. Instead, they usually stop hiring. First, they reduce overtime. They become more selective about filling open positions. Only if conditions continue deteriorating do larger workforce reductions begin. That's why professional investors spend just as much time watching hiring trends as they do unemployment itself. A slowing labor market doesn't automatically mean a recession is coming, but it does suggest that businesses are becoming more cautious. Banks pay close attention to that caution because employment affects almost every type of lending they provide. Stable employment supports mortgage payments, credit card repayments, auto loans, and business borrowing. When employment weakens, even gradually, the level of risk across loan portfolios begins to change. Now, let's add another piece to this puzzle: commercial real estate. During the pandemic, millions of employees began working remotely. While many companies have returned to offices in some capacity, demand for office space remains uneven in many cities. Some buildings remain partially occupied. Others face refinancing challenges as loans made years ago at very low interest rates mature into today's much higher rate environment. This doesn't mean every office building is in trouble. Far from it. High-quality properties in strong markets continue attracting tenants. But weaker properties are facing a very different reality. For banks with significant commercial real estate exposure, that creates additional uncertainty. Again, uncertainty, not necessarily losses. There's an important difference. One of the biggest mistakes investors make is assuming that every potential risk immediately becomes a financial disaster. History shows that's rarely how markets work. Instead, markets constantly adjust probabilities. If the chance of slower loan growth increases, investors adjust valuations. If the possibility of higher loan defaults rises modestly, stock prices reflect that risk. That's why you sometimes see bank shares decline even after reporting excellent earnings. The market isn't judging yesterday, it's trying to estimate tomorrow. And sometimes tomorrow looks less certain than yesterday looked profitable. Here's the part almost no one talks about. Bank earnings themselves can actually create unrealistic expectations. Suppose a bank reports record profits for 2 consecutive years. Investors begin assuming that level of profitability will continue indefinitely. Analysts raise forecasts, expectations climb higher and higher, but businesses don't operate in straight lines. Economic cycles exist because conditions constantly evolve. Interest rates change. Consumer behavior changes. Government policy changes. Corporate investment changes. The strongest companies adapt to those changes, but their earnings rarely grow at exactly the same pace forever. That's why experienced investors spend less time asking, "Were earnings good?" and more time asking, "Can these earnings continue?" Those are very different questions. Another area receiving increased attention is household savings. During the pandemic, many families accumulated unusually large savings thanks to stimulus programs, reduced travel, and lower discretionary spending. Those excess savings provided an important financial cushion that supported consumer spending even as inflation accelerated. But over time, much of that cushion has gradually been spent. That doesn't mean Americans have stopped saving. It means many households have less financial flexibility than they did 2 or 3 years ago. Think of savings like shock absorbers on a car. When they're strong, unexpected expenses can be handled without significantly disrupting financial stability. When those shock absorbers wear down, every bump in the road feels much larger. That's exactly why banks monitor savings rates, deposit growth, and consumer spending so closely. They're trying to determine whether households are simply adjusting to a new economic environment or whether financial stress is beginning to build beneath the surface. So far, the evidence suggests something important. The American economy is not collapsing. Consumers are still spending. Businesses are still investing. Banks remain well capitalized, but the pace of growth has become more uneven. Some sectors continue expanding rapidly, while others have clearly slowed. And when an economy enters this kind of transition, financial markets often become much more sensitive to every new piece of economic data: a single inflation report, one employment release, an update from the Federal Reserve, a change in consumer confidence. Any of these can shift expectations almost overnight because investors are trying to answer one critical question: will the economy achieve a soft landing where inflation continues easing without a major slowdown, or will tighter financial conditions eventually weigh more heavily on households and businesses? That's the debate quietly shaping Wall Street today. And there's one area of the financial system sitting directly in the middle of that debate: an industry worth trillions of dollars that many Americans have never heard of, yet one that has become increasingly important to banks, institutional investors, and the broader economy. Understanding how it works may completely change the way you think about financial risk. In today's market, the part of the financial system we're about to discuss rarely appears on the evening news, yet it has become one of the fastest growing sources of lending in America. It's called private credit, and unless you work in finance, there's a good chance you've never heard much about it. For decades, if a company needed to borrow money, it usually went to a traditional bank. The bank evaluated the business, approved a loan, and held that loan on its balance sheet. It was a straightforward relationship that had existed for generations. But over the past 15 years, that model has gradually changed. Today, many companies bypass traditional banks altogether and borrow directly from large investment firms, pension funds, insurance companies, and specialized private lenders. Collectively, this market has grown into an industry worth well over $1 trillion, with some estimates placing it closer to $2 trillion globally. That growth didn't happen because something was broken. It happened because the financial system evolved. After the 2008 financial crisis, regulators required banks to hold more capital and become more conservative in certain types of lending. Those reforms made the banking system stronger, but they also created opportunities for private lenders to finance deals that banks no longer wanted to hold directly. In many ways, that's been a success story. Private credit has helped businesses expand, supported middle-market companies, and provided investors with an alternative source of income. But every rapidly growing market eventually reaches a point where investors ask an important question: what happens when economic conditions become more difficult? This is where Wall Street has become more cautious. Many private credit loans were originated during years when interest rates were historically low, economic growth was strong, and refinancing was relatively easy. Today's environment looks very different. Borrowing costs are higher. Economic growth has moderated. Some industries are adjusting to new technologies, changing consumer behavior, and higher operating costs. None of those developments automatically create widespread losses, but they do increase the importance of loan quality. Think of it like lending money to a friend. If your friend has a stable job, growing income, and manageable expenses, you're probably comfortable making the loan. If that same friend's income becomes less predictable while expenses continue rising, you don't necessarily expect them to default. You simply recognize that the level of uncertainty has increased. That's exactly how professional investors are thinking about private credit today. They're not assuming disaster, they're reassessing risk. And this is where most people get caught. Many investors believe financial markets move only after bad news becomes public. In reality, markets often adjust well before problems become obvious. Institutional investors constantly reevaluate probabilities. If they believe economic growth could slow slightly more than expected, they'll begin adjusting portfolios. If they think loan defaults may rise modestly over the next 2 years, they'll incorporate that possibility into today's investment decisions. That's why you sometimes see increased trading activity in bank stocks, even when there hasn't been any major negative headline. The market isn't reacting to today's reality. It's reacting to tomorrow's possibilities. Now let's connect this back to America's largest banks. Banks aren't isolated from the broader financial system. Many provide financing to private investment funds. Some arrange lending facilities. Others participate in syndicated loans or provide various financial services that connect them to this growing market. That doesn't mean every dollar of private credit risk sits on bank balance sheets. It doesn't, but it does mean the banking system and private lending markets are more interconnected than many people realize. And when investors become more cautious about one part of the financial system, they naturally begin evaluating the others as well. This isn't new. Financial history repeatedly shows that markets pay close attention to connections, not because every connection creates a crisis, but because interconnected systems transmit both opportunities and risks. That's one reason recent Federal Reserve communications have been watched so closely. Every statement about inflation, every comment about interest rates, every update on economic growth. Each one helps investors estimate where borrowing costs may go next. Higher interest rates generally improve some areas of bank profitability because lenders can earn more on certain loans, but they can also reduce borrowing demand. Businesses may delay expansion. Families may postpone buying homes. Consumers may become more selective about major purchases. Finding the balance between those forces is one of the biggest challenges facing both policymakers and financial institutions today. There's another number that deserves attention, not because it's predicting a crisis, but because it helps explain why markets have become increasingly sensitive. It's the amount of debt throughout the financial system that's supported by leverage. Leverage simply means using borrowed money to increase investment exposure. Used responsibly, leverage can be an effective financial tool. Businesses use leverage to expand operations. Homeowners use mortgages to purchase property. Investors sometimes use leverage to enhance returns. The key word is responsibly, because leverage magnifies outcomes in both directions. When investments perform well, gains can be larger. When investments decline, losses become larger too. That's why experienced investors pay close attention whenever borrowing across financial markets rises rapidly, not because borrowing itself is dangerous, but because highly leveraged markets become more sensitive to unexpected events. Imagine two investors. The first invests only the cash they already own. The second borrows heavily to buy the same investments. If markets fall by 10%, both investors experience losses, but only one may receive a call requiring additional cash or forcing investments to be sold. That's the difference leverage creates. It doesn't cause market declines, it accelerates them once they begin. Professional investors understand this extremely well. It's one reason periods of elevated leverage often lead to higher market volatility. Again, higher volatility does not automatically mean lower long-term returns. It simply means markets become more reactive. And that's exactly what we're seeing today. Small pieces of economic news are producing larger market reactions than they might have just a few years ago. Why? Because expectations have become more fragile. Investors are no longer asking whether the economy is growing. They're asking how long current growth can continue under higher borrowing costs. Persistent inflation pressures and changing consumer behavior, those are much more complicated questions. And they don't have simple answers. But perhaps the biggest mistake ordinary households make is assuming these discussions only matter to professional investors. In reality, they affect nearly everyone, whether you're applying for a mortgage, planning retirement, growing a small business, building an investment portfolio, or simply trying to protect your purchasing power. The decisions being made inside financial institutions eventually influence the interest rates you pay, the returns you earn, and the opportunities available to your family. That's why understanding these trends isn't about predicting the next recession or trying to time the stock market. It's about recognizing that financial conditions quietly change long before most headlines acknowledge them, and once you recognize those changes, you can make better long-term decisions instead of reacting emotionally after everyone else has already noticed. In the next part, we'll bring everything together by looking at the two very different financial paths households are taking today, the practical steps you can take this week to strengthen your own financial position regardless of what happens next, and why long-term wealth is usually built not by predicting every economic cycle, but by preparing wisely for all of them. One of the most interesting things happening in the American economy right now isn't found in a stock chart or an earnings report. It's happening inside ordinary households. Over the next 5 years, the financial gap between families is likely to grow, not simply because some people earn more than others, but because they're responding to the same economic environment in very different ways. Think of it as two households starting from similar positions. They both have jobs, they both pay taxes, they both face higher grocery bills, higher insurance costs, and elevated interest rates. Yet by the end of the decade, their financial outcomes could look dramatically different. The difference isn't luck. It's the decisions they make while the economy is changing. The first household is reactive. When inflation rises, they rely more heavily on credit cards to maintain the same lifestyle. When interest rates increase, they ignore opportunities to refinance or reduce unnecessary expenses. They postpone saving because they believe they'll start once things get better. Every financial decision is made in response to today's pressure. Understandably so. Life gets busy. Unexpected expenses happen, but over time, those short-term reactions quietly compound. Credit card balances become larger. Interest payments consume a greater share of monthly income. Emergency savings remain thin. Retirement contributions are delayed year after year. None of those choices feels catastrophic in isolation, but together they gradually reduce financial flexibility. Now consider the second household. They're facing the exact same economy, the same inflation, the same interest rates, the same uncertainty, but instead of trying to predict exactly what markets will do next month, they focus on strengthening the areas they can actually control. They review their monthly cash flow. They increase retirement contributions whenever income allows, even if it's just 1 additional percentage point. They prioritize paying down high-interest debt before taking on new obligations. They build an emergency fund that can cover several months of expenses. Most importantly, they make these decisions consistently, not perfectly, consistently. That's where compounding begins working in their favor. Small improvements repeated over many years often produce results that appear surprisingly large in hindsight. This is one of the biggest lessons financial history teaches us. Wealth is rarely built through dramatic, one-time decisions. More often, it's built through hundreds of ordinary decisions made with discipline over long periods of time. Now let's bring this closer to home. If you're in your 30s and renting, today's interest rate environment may make homeownership feel frustratingly expensive. That doesn't necessarily mean buying immediately is the right answer. It means understanding exactly how much home fits comfortably within your budget, maintaining a strong credit profile, and building a meaningful down payment while avoiding the temptation to stretch beyond what your monthly cash flow can realistically support. Buying a home is one of the biggest financial decisions most families will ever make. Patience can sometimes be just as valuable as speed. If you're in your 40s, and balancing children, mortgage payments, and retirement savings, you're probably experiencing what economists sometimes call the financial squeeze. Expenses often peak during this stage of life. College planning, healthcare costs, home maintenance, family responsibilities. It becomes tempting to reduce retirement contributions in order to solve today's challenges. Sometimes that's unavoidable, but whenever possible, protecting long-term savings during these years can have an outsized impact because your investments still have decades to compound. If you're in your 50s and the conversation shifts again, retirement is no longer an abstract goal, it's approaching. This is often the right time to review asset allocation, estimate future Social Security benefits, understand expected healthcare costs, and evaluate whether current savings are aligned with your retirement goals, not to create anxiety, to create clarity, because clarity reduces uncertainty, and uncertainty often leads to better decisions than assumptions. If you're already retired or planning to retire within the next few years, today's environment presents both opportunities and challenges. Higher interest rates have improved yields on many conservative savings vehicles compared to several years ago. At the same time, inflation continues affecting purchasing power. Finding the right balance between preserving capital and maintaining enough long-term growth becomes increasingly important. That's why many retirement specialists emphasize diversification rather than concentrating too heavily in any single investment or asset class. Regardless of your age, there are several practical steps worth taking this week. Start by calculating exactly how much of your monthly income goes toward debt payments. Not because debt is automatically bad, but because understanding your debt-to-income ratio provides a clear picture of financial flexibility. Next, review your emergency savings. Could your household comfortably handle 3 to 6 months without income? If the answer is no, building that reserve may deserve higher priority than chasing higher investment returns. Then examine your retirement accounts. Have contribution rates remained unchanged for several years? If your income has increased but contributions haven't, even a modest adjustment today can significantly improve future outcomes thanks to compounding. If you haven't reviewed your credit report recently, consider doing so. Errors happen more often than many people realize, and maintaining strong credit provides flexibility whenever borrowing becomes necessary. Finally, take a fresh look at recurring expenses, subscriptions, insurance policies, utility plans, streaming services. Small recurring costs often receive little attention because each one seems insignificant, but together, they can quietly consume hundreds or even thousands of dollars each year. Recovering just a portion of those expenses can strengthen household cash flow without requiring dramatic lifestyle changes. Notice something about these strategies. None depends on predicting the stock market. None requires forecasting the next Federal Reserve decision. None assumes you know where inflation or interest rates will be 6 months from now. Instead, they're designed to improve financial resilience regardless of which direction the economy ultimately moves. And that's perhaps the most important lesson from everything we've discussed today. Financial success isn't built by correctly predicting every economic cycle. Even professional investors rarely do that consistently. Instead, long-term financial security usually comes from preparing thoughtfully for multiple possible outcomes. That's exactly why Wall Street is paying such close attention to the banking sector today. Not because the system appears to be failing. In many ways, America's largest banks remain considerably stronger than they were before the last major financial crisis. But strength today doesn't eliminate uncertainty tomorrow. Markets are constantly reassessing risk. Households should occasionally do the same. Not with fear, not with panic, but with awareness, because awareness creates better decisions. And better decisions, repeated year after year, become the foundation of lasting financial security. So I'd like to leave you with one question. If the economy looked exactly like it does today, 5 years from now, would your financial plan still put you on track to reach your goals? Take a moment to think about that. I'd genuinely love to hear your perspective, so let me know your answer in the comments below. If you found this breakdown helpful and you enjoy calm, fact-based explanations of the economy, investing, retirement planning, and the financial trends shaping everyday life, consider subscribing to the channel. Every week, we'll continue breaking down the numbers behind the headlines so you can make informed financial decisions with confidence, not emotion. Thanks for watching, and I'll see you in the next video.